All right. Good morning, good afternoon, or good evening, depending on where you live. Welcome to our Tuesday edition of our webinar for Triple Threat. And I'm telling you, my heart is racing today. Um, obviously, I'm excited to start September. Yeah, yes, I think we got a full plate today, and market never seems to disappoint. Let's see. Well, as Maxwell Smart used to say, missed it by that much. Hi, Omar. Good start to a week. Yes. Well, on one level, it is because we, this trading business of ours, this thing of ours, um, can be such a wicked mistress sometimes, and it's days like this that are very exciting, and also they take, like I was saying in the forum, they take the breath right out of your lungs. Um, it's just one of those situations where, oh wait, let me get my pointer up here because it helps. It's just one of those situations where it's like you can see things coming a ways off, and you patiently wait for your opportunity, and your opportunity comes when you're not looking, like this. As I've said a million times, I just don't trade Asian session, and if this candle had come during an hour before London opened, I would have taken the short, but it didn't. So I had to look for another opportunity. Well, the candle that was the one was it 1 hour before was here, and then this was our London Open candle. So by the time we got to London Open, we're already smashing into the major weekly trend line that we've been watching for months, and there's no way. I mean, the big candle didn't necessarily scare me, but the position where it was did. And I mean, I can't say for sure what's going to happen next, but that should definitely give you pause that you don't want to take a short right into an area of support and resistance that huge. So miss the first entry. First entry, could have given you 90 pips. But it's okay. But that's okay. That's just part of trading. So we have to try to find the silver lining here. Is that it looks like the market's waking up, and this couldn't come soon enough for us that have been struggling through August and grinding and just getting our dreams dashed by crappy market moves. One of the other things that was most heartening for me today was I check Forex Factory every single day, specifically for this little number down here, because it gives you a really good pulse of the market. This liquidity number right here, and I use it all the time to get kind of a feel for the overall market, because this is the aggregate of a bunch of different brokers' liquidity levels and how much activity they're getting. And so it's a really good barometer of how much market participation we had. And as London opened, and the first bit of the London session, we were up to 144% above average. Those numbers I haven't seen in 2 months. And right now we're holding steady at 67% above average. Now, the last 3 or 4 Tuesdays we've had our webinar, that number has been flat, -4, -10, +5, +10% above average. So already September is starting, and we're already we're getting better volume in the markets, which is great. Oh, look at this. Oanda halts margin trading on precious metals in the United States. So another one falls to Dodd-Frank. And I've never recommended that broker, but anyway, so these are positive signs, but you shouldn't look at this as, oh darn it, I've missed all the action and my trading week is ruined. No, quite the contrary. If we're starting to see these kind of days, then we can start to shift our focus rather than from this ultra-conservative, scared of the market approach to let's get back down to taking signals consistently, in our commodities, and we're going to start making some more money with them. So I see this as a positive. Yeah, it was tough. And the other one that was kind of a toughie for me was the FTSE, because I wanted, as I said in the outlook, I wanted the midterm fib level to break, and I mean, I think it did barely, but it wasn't that looked kind of spotty as a breakout, and now the market's bumped up a bit. So again, that was a trade that got a little bit dashed because it wasn't a good breakout. One of our members, let's see if he's attending, had pointed out that there's some, yeah, he is, he's here. He had pointed out that there's some major news coming on the pound right at the end of our live session. So, maybe it's best that that I avoid it. I'm not sure, because again, I don't necessarily know the correlation between that particular news announcement and how the FTSE works. So I'm probably what I'm going to do, and I'll get to it in just a second, because we have the construction PMI in 1 hour for the pound. What I'm probably going to do is I'm going to set, at the end of this candle, if it closes where it is, I'm going to set a buy limit right here on this line, and probably put my stop down here. So it's probably not going to be a very big stop loss, and I'll see if I can get pulled in. I'll just put it right there. Yeah, so we're talking about 11 pips, maybe like a 15 pip stop, and I'll put a buy limit there. See if I can get it caught. If not, oh well, I missed the trade. But definitely things are looking better. But let's go back to our prime real estate, so to speak, and that's going to be gold. So now that we've seen this breakout of that 4-hour triangle that I put on the manual chart for the weekly outlook, where do we go next? What would be a valid course of action to do now? Obviously, the one thing that we could do, which is a very, very wise decision, and you can never knock yourself for this, is don't do anything. Just wait till tomorrow. Let's see how the whole day plays out before making any decisions. There's no reason we have to take a trade today. In fact, if you use last week as an example, our Tuesday trades stunk. But Wednesday was flat. Thursday opened up lots of opportunities, and lots of members made money on Thursday. And those of you who carried trades into Friday made money. So there were lots of really good opportunities later on in the last week, and if we jumped on all the opportunities on Tuesday, it wasn't that great of a week. But if we were patient and waited for the better opportunities to develop, that made more money than just jumping at the first thing we saw. And so I kind of want to take that on a weekly basis this week, and then I want to extend it out to the fall and say that this is really the first trading day of the fall. And so we don't have to put all our chips on the table and go all in on the first day of fall. No, let the market come to us. We want to be patient. We want the best opportunities, that when we take a trade, we have this level of confidence that we have command of what's going on, rather than, oh, the push and pray approach, where it's like, oh, well, that's kind of a signal. Oh, let's go ahead and take an order, and oh my gosh, I'm going to frantically watch the market and hope that it works out. No. We want to be in a position of confidence. The whole point of using this system is to give you confidence in your trading, that when you make a decision, it's really just there to help you make a good trading decision. And when you make that decision, you want to be able to say, oh, I took a good trade. Win or lose, I know it was a good trade to take, because sometimes you can lose good trades and you can win bad trades. And don't let the wins and losses alone determine your confidence level in the market, because my first live trading account, when I knew nothing, I tripled it in the first 2 weeks, I think. And I tripled it on bad trades, okay? And then I wiped out 80% of it in one night because of the false confidence that gave me, because I didn't know what I was doing. And there's times, over the last few weeks where we've taken good signals and lost, and it does kind of hurt because it's a good signal, but at the same time, I don't regret any of them, because I knew we were just following the plan, and the plan was good signal, take the trade. Good morning. Sorry I'm a little late. Hope I haven't missed much. No, we were just basically discussing the overall situation in the market, that things are starting to wake up, and although it can be very frustrating to miss a good move like we saw in gold today and kind of get snubbed on the footsie a little bit, it's okay because this is just the first day of fall and it's the first day of the week, and we can always just let these moves develop and hopefully, you know, catch a better trade with more confidence later. And that's really the gist of what I'm discussing. That, in addition to the fact that there's been much higher volume today at London Open than I've seen for the last month and a half, which is a great sign. So we've got lots of things going in our favor, and now it's up to us what to do next. So we can't change the trade that we didn't take, and we shouldn't even think about it. But what we can do is we can use what the market has told us so far today to try to formulate what our approach is. And that, like I said, the first part of that approach is that we don't have to do anything. We don't have to chase anything. We just now have to understand that, okay, look, gold woke up. Oh, geez, we moved 115 pips outside of that triangle. Great. And that was a beautiful looking move. This is just a classic. This is a classic gold move. We had the breakout, we had follow through, we had retrace, and then we had the big move. These are all functions that we see in a normal gold market, and this is, you know, so, you know, my recommendation was that if you're going to trade right now, you take the momentum master signal without waiting for Fibmaster, but actually you had a good opportunity on Fibmaster as well and on the manual chart. So you had the triple threat setup, the classical triple threat setup. It just didn't come at the right time. And again, this is abnormal, and it's probably going to change as we get into fall, that we'll see better setups during London. Good morning, Omar. Thanks for all your help and dedication. Thank you. I appreciate that. That's very kind of you. Yeah, I you know, you guys are great people to be dedicated to, and you know, I want everybody to succeed, and I love hearing about your success, and that's my goal. That makes my week, makes my day, makes my month. But we have a gold market that seems to be waking up. It has finally hit this area that we were looking for. And you know, we've been watching this weekly trend line forever, and today's the first day it actually got hit. And as anticipated, we've got a rejection so far of that area. Is it a big enough rejection for me to take a long at this candle close? Absolutely not. Oh, speaking of, I got a question about the star rating system that I use for reversals. And I have posted this in the Triple Threat blog. So if you guys want to check out this article when you have time, this will give you a good quantitative way to score rejections. And if you follow the 3+1 star rating system for reversals, you're going to put yourself in a higher probability situation for any reversal trade that you decide to take based off of a reversal candlestick formation. And you know, that was based off of our discussion either last week or the week before, where gold looked like it was a reversal candlestick, and that was a good time to get out of the trade, even though it didn't end up working out that time, but the later reversal did. So looking forward, now what I see is a great opportunity. There's going to be really essentially one of two scenarios that I can see playing out here in gold. The one that excites me the most, the one that I'm most hopeful for, is that this is just the first run at this area before we puncture it. And when we puncture it, that could be letting a lot of water out, and we could get our first big gold move of the fall. And that's what I'm more hopeful for. So essentially, what we want to see is like I was saying, this classical gold breakout, pullback, breakout move. You know, we made a breakout, we made a little consolidation pullback, and then we made the next big move down. Essentially, I want to see this exact same situation happen a second time, where we pull back to maybe 1279. We've already pulled back to 1277.65, maybe all the way back to 1281.25, and then that's followed by a breakout of this major trend line. Now remember, the trend line technically isn't a valid breakout until we have a weekly close below it. but that doesn't mean we can't trade it. It just means that it's not confirmed as a full breakout of this trend line until we get a weekly close outside of it. But I am definitely willing to venture a trade if the setup suits the move. If we can't just go from this trend line and puncture it just by a few pips, and then that's good enough for me to take a breakout trade. But if we have now made, we've now made a solid move down, little consolidation, solid move down, we've hit this major area of support and resistance, we wouldn't expect to clear through at our first attempt. So now we may get a pullback, we may get a bigger pullback. And maybe that's all we're going to see today. And maybe we'll get a sideways, move. And then that's going to set up an Asian session range, and we'll look for the breakout of that range tomorrow for tomorrow's trading. And if we get a breakout of this trend line tomorrow and that's the way it comes at us, then I think we have a valid breakout that we can start trading. But again, it's not fully confirmed till the week's over. So, we don't have to get overly jumpy with it. It could be the start of something big, and it might not be. This could reverse now for several hundred pips to the upside. So we have to be prepared for that option. If that does happen, the one area that I'm going to be definitely looking for a retake on is going to be 1281.25, which is going to be here on the Momentum Master. That's most likely not going to produce a Momentum Master System long. So even if we do retake 1281 as we float back up, I'm not going to take a long trade. It would have to be a good setup as well as a reversal away from the trend line. I just think, based off of what gold has been doing and what we've been seeing a lot of, I really think that there's a lot of downward pressure. The dollar has been getting stronger. The U.S. yen has finally broken out of that ridiculous 2014 range. The dollar's just been the dollar index is strong across the board. We've been seeing a lot of that dollar strength, and so that plays well into that being a catalyst for gold to really finally make a move outside of its range. Of course, we've had this geopolitical pressure to keep gold up, and but eventually one of those catalysts has to push further than the other can push back. And I think maybe the dollar strength is that catalyst that we need to get out of this weekly range that we've held for so long. You can see when you look at the weekly chart, oh, this isn't anything crazy. This isn't a big weekly move. No, not yet. And, I just want you to keep in mind, here, hold on. I want you, rather than to be myopically focused on the trend line right now, I want you to keep in mind what a good weekly trend can turn into. This may, let me measure it actually. That little candle up at the top is a weekly candle of the 350 pip variety, right? So let's say we get our trend line breakout, and then look, the resulting next 3 weeks added almost 700 pips to that initial 350 pip weekly breakout. So what I'm saying is, don't think that you've missed all the fun if this breaks out a couple hundred pips by the end of the week and we're outside and it's like, oh shoot, I missed the breakout, I've missed all the fun. And if you look at that situation where this is actually up here a very kind of smaller weekly candle of the 350 pip variety, the resulting 3 weeks produced an extra 700 pips after that move. The next reversal right here, after we had a float back up, a retrace, we had a bearish engulfing, and then let's look at what the following 3 weeks produced after that move. So then the following 3 weeks gave us another 800 pips. Again, some of these moves on a weekly basis are colossal. So that in a single week is 1,100 pips. This in a single week is 1,700 pips in 1 week. Okay, so yeah, we have to keep this in perspective that, yeah, we may get the breakout, and yeah, we may miss the first opportunity at it, but that doesn't mean that we won't have other opportunities to make way bigger trades. So we have to be conservative in our approach, because we can't just jump on another trade that looks like a breakout, and we're getting late to the party, and then we get another stop loss, which is going to put us in that psychological state of mind that, oh, geez, I'm not going to take another gold trade because I don't want it to blow up in my face. And then the one that you really should have been waiting for to take, you don't take, and you miss the 300 or 400 pip daily move that the next day moves another 300 pips or 400 pips. And in a 2-day period, there's a 700 pip gold move that you've missed. And just think about it from whatever lot size you're using, multiply whatever lot size you're using by 600 pips, and then compare that to your 45 pip stop loss, even if you've lost 2 or 3 trades in a row. So you can see that one good move essentially gives you all the gains you need for a month or 2 months, and that's what we're shooting for. So we want to make sure that we're positioned well to take advantage of the real move. What we saw today was a great breakout, and it's really just more of a confidence builder as far as I'm concerned for the market, but it's not necessarily, oh, geez, here's the move, let's go ahead and all pile in. Definitely not. But there is going to be an opportunity potentially either later today, I see, if this is, I mean, if we've got some strength here and it's just the market participants, you know, a few of the big boys are back from holiday, they're coming back to work early, and they're like, you know what, let's go ahead and bump gold, you know, $20, $30, $40 down because of the U.S. strength, and geez, what's been going on since we've been in the Cayman Islands, and we get, you know, a nice consolidation over the next hour, next 3 hours, next 4 hours, and then sometime after New York opens, or maybe an hour after New York opens, we come back down and actually take this trend line. I'm not saying that that's going to be a low risk trade. It won't, but it is. You know, it is an opportunity to take a trade. Omar, can we look at the European indices and oil before the hour candle closes? You are so enthusiastic about gold. It is goldtrademaster.com. This is the commodity that got me really excited about trading after I got a little burned out on Forex for a while. So yeah, I'm sorry, but it's exciting for me to see my baby come back to life. But I agree with you 100% that we should go around the horn because we have some really exciting stuff on oil, and in 8 minutes I'm probably going to take a short on Brent. Okay, so let's go ahead and discuss the FTSE move. FTSE is definitely, I can see this as a potentially pre-major news market. You can see we have a lot of spikes. This is definitely indecision. These spikes that we're seeing, that means that the overall market flow, in my opinion, is up, but there's a lot of people that are very jumpy about holding their positions, so they're getting a little bit of profit and they're getting out. I would say that it would be wise to wait until the end of next hour to trade the FTSE because of that pound news. So the higher risk option is to put a buy limit in at the fib, and I think I'm probably going to do that with a smaller position here at the end of the candle. So, well, I don't know. If the candle closes with a big wick and no body, then I want. Yeah, I'm probably going to scratch that. You know, again, we have to make good judgments. It's good trading. We try to make it as mechanical as possible, but again, it's always a judgment call. So if we see a lot of evidence saying this isn't really a real move, then we just don't take the trade, and we could be wrong, and the signals could be right, as they are so much of the time, but that doesn't necessarily mean that we made a bad trade by not taking the trade. Okay, so I want to get to, oh geez, Brent's moved quite a bit. Brent actually had a setup for us. It was just a squeaker outside of the superconvergence zone, away from the midterm fib. We've gotten Williams confirmation this hour. That to me looks like a setup. I will take a position in Brent. My stop loss will be up here above the bullish Dynafib. I think that probably gives us not too bad of a stop loss. Yeah, it's a 45, 50 pip stop loss, looking good there. Okay, we've got Williams confirmation. Our last cross on the RSI was bearish. We've got a complete breakout of the superconvergence zone, a breakout of the bearish Dynafib. We've also got a structural setup that I like, which is that we hit a midterm fib, we broke below, consolidated, retest, 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 fail. And that, to me, sets up a good short on Brent. But as I've said before, and of course, taking the Momentum Master System trade first would have produced the best entry possible, but again, it's kind of a higher risk one. So as I've said before, I definitely wanted some confirmation on both charts between both oils that I was getting on the same side of both oils. And although we are still blue candles here, we have been in a consolidation for a while, and this looks like it'll be 2 bearish candles in a row breaking away from the super convergence zone area. Now, although this is not an ideal setup on crude, it does play well into the setup on Brent. Also note that the Williams is now dropping out of the buy zone, which the Williams is your greatest indicator to keep in a trade, and when it drops out, you can get out of that trade. So that's a great moving trade indicator. As we quickly move to the DAX in the last 4 minutes here, this is precisely the setup I've been looking for here on the DAX. Looks like we'll just about get Williams confirmation. Last hour sat underneath the midterm fib. But we did clear and close above the super convergence zone area. This candle here in about 4 minutes looks to be closing above the midterm fib. I will initiate a long position. I will move my stop to entry as we approach the super convergence zone above. So lots of opportunities again today, but don't go chasing after. Don't go chasing after trades you're not confident with. Right now I'm looking at positions on oil and the DAX. And I just wanted to come back to the FTSE to see how we were rolling, and it looks like we're going to have a pretty big top wick for 2 candles in a row, and that's, I'm just going to officially say it right now that I'm not going to put my buy limit in on the FTSE. I'm going to go ahead and take a market long on the DAX, and I'm also going to take a market short on Brent. And if I can get my Brent trade to break even, and that also coincides with a good move on crude, which I'm really looking for a Momentum Master setup on crude, I will, if I can get my Brent position to break even, I will then add a short position on crude based off of that setup. But again, I will not, as we've discussed in the forum, taking a position on oil is taking a position on oil. So just because it's Brent or WTI or XTI or whatever, if you're short oil on one, you're essentially short on them all. So adding a position on another type of oil is essentially adding to your original trade, which is okay given that you follow the rules that I mean, you don't have to follow my rules, but I've created the rules for safer, more accurate trading, and that's what I recommend. So we've got about a minute and a half. I'm going to let's see where we're at with gold. Gold looks like it has not been able to retake 1277.65. This is going to be an interesting next hour on gold. If we do get a punch through of that trend line, again, higher risk, but I will probably take a short position if we get a punch of that trend line and we get a close below it, unless the caveat is, unless it's a huge breakout candle, in which case I'll just snub it and look for a move tomorrow. Possibly we would hope for an Asian session, retrace back to the trend line, and hopefully get some sort of Asian trading range going, and then be able to work from that. Okay, so we got 30 seconds. Hold on, I'm going to place my trade. Okay. So, all right. It's been definitely a very exciting session to start off our September with. And I'm hopeful, and let's see, do I have any new signups that just signed up? Yep, we got 1, 2, 3. Excellent. Welcome to our new members. Sorry that I just kind of got jumping into this webinar. I didn't have a chance to welcome our newest members to the team, and I hope that you will make use of the forum and go meet your new trading partners. I guarantee you they will be very welcoming and accommodating. We have built ourselves quite a team here, and we all work together to make sure that even during the toughest markets that we all stay positive and we still try to do the best we can to make money. So welcome, welcome, welcome. And of course, by all means, make use of all the resources, and if you don't see something that you need, let me know and I'll make sure that it's available to you. Okay, so now that we've gotten kind of a good overview of the market, does anybody have any questions or anything they want to look at more closely, anything they want to discuss, anything at all? Oh, that is a good idea. All right, let's go ahead and talk about the U.S. indices. I've gotten into this habit of focusing very heavily on the European indices because it just makes more sense for us to really attack those during our London session, and then as we go into that New York outlook, we focus heavily on the U.S. indices. So we'll go ahead and take the Dow from the daily, and this is kind of, I've found that the Dow, as we analyze the Dow, so goes the S&P 500 and the NASDAQ. Although the NASDAQ has been the strongest trender in the last major up move, so they don't all move the same, and the S&P 500 tends to be the most volatile, and it's the one I avoid more. I like the Dow. The Dow is, out of the 3 U.S. Indices, the Dow is my favorite, followed by the NASDAQ. So as we look here on the daily from the FibMaster, is we just get an overall feel for the structure of what's going on. We had our first deep dig in months, pretty much all year. After we've stayed pretty consistently to the upside as we've moved higher. Now, clearly, this superconvergence zone area and the next midterm fib up at 17,188, this is going to be a phenomenal area to watch. And I think the next big leg higher has to come as we penetrate these two areas. So that's definitely what we're going to be watching. You can see over the last, at the end of last week, the last few trading sessions, we came and we bumped into this. We failed to retake 17,031, which, remember, we had a good bouncing off trade from that area. It worked out 2 different times. We had our initial breakout of 17,031 here, and then we had our take profit up at super convergence zone. We then pulled back. Remember, last week we thought we might re-break it to the downside and set up a short trade. That never materialized, and we had a rejection again, and we bounced back up to the super convergence zone. This week we find ourselves, more things are apparently lining up behind the scenes for convergence, and we are now bouncing in between 2 super convergence zones here. Obviously, the next breakout, the desirable breakout, will be to the upside because there's less traffic in the way. You can see we're pretty clear to the top. If we go to the downside, we have our super convergence zone followed by a midterm fib, followed by a dynafib, followed by another dynafib, followed by another midterm fib. The downside move is a lot trickier and therefore would require much more patience and development to go short, which makes sense because we've been in an uptrend. So essentially, we're going to want this uptrend to continue for the easiest, smoothest trades, and a breakout of the super convergence zone along with the midterm fib would give us just what we're looking for to accomplish that. And so for the Dow, that is essentially what I'm looking at for my next move. Now as we jump down to the hourly, we can see that there has already, from a Fibmaster standpoint, been a little bit of an opportunity. You can see after we consolidated in the Dynafibs, we made a solid move away from the bullish Dynafib, consolidated a little more, and moved higher. Currently, price is heading even higher, and will eventually, hopefully, hit that next super convergence zone. What happens after that is anyone's guess. We don't try to guess. We just try to trade the good setups. We may very well reject it. That may give us a little bit more of a pullback before the market makes another run at it. If you're of the thinking that the Dow can't possibly push higher, the U.S. is not in that good of a position, which it's not, you would be in the camp of everybody else who has tried to short the Dow. I mean, I'm not saying that you would short the Dow, but I'm saying everybody who has tried to short the Dow on this last dramatic move up and has gotten their lunches eaten for them, that's not what I would recommend. I would recommend that you read what the market is telling you, and if the market says that it's going higher, believe it until it tells us otherwise. And there can be those transitionary periods where it says it's going higher and then reverses, and then that just should make you take caution, not think that the market was lying to you. So essentially we have a relatively good structure if we get a good break. Looking at the S&P, we find ourselves in a similar situation. We have another super convergence zone of similar score, a 6+ score, which is pretty high, right above where price is now after a similar consolidation. A break above this area, which is also clearing now 2,000, gives us actually pretty good distance as far as the S&P is concerned, up to, what is that, 2015.6. So that could be a decent move. Again, I usually lean towards taking trades on the Dow over the S&P because the S&P tends to be a bit jumpier. Finally, the NASDAQ actually looks like this hour is producing a breakout. We are already in the Williams buy. The last we had a pretty recent RSI cross that was bullish, and it looks like we have a trade forming there. We've already had the move on the Momentum Master. So again, this looks, out of the U.S. indices at the moment, this looks to be the cleanest trade you could take at the end of this candle. Again, I'm not necessarily endorsing the trade. I'm just saying that out of the three, it looks the cleanest. Finally, I kind of wanted to just, before I get to any more questions, I kind of wanted to just touch on some of the moves we saw in Forex. Last week's Euro move was an excellent trade, and it ended up going pretty much straight down. I can't remember exactly how much. 27 pips, not too stellar. If you had caught it just from the simple rejection of the midterm fib, or there, it was a better move. But if you waited for Momentum Master, it didn't get that much out of it. Right now, it is kind of setting up maybe for another break. If it makes another good run at 31.22, there's potential short there. I have been keeping an eye more along the lines of the pound crosses. I like the daily range of the pound crosses, and even the pound yen has given some beautiful trades. We're a little bit extended on the pound yen at the moment. And the pound Aussie is really kind of what I see as the closest setup to happening now. If we can break the bearish Dynafib, that will probably also produce a sell trade on the Momentum Master system. I will be looking for that one. We had a decent setup on the pound versus US dollar, which came at the exact same time on both the Momentum Master system and the Fib Master system, and at best has gone for 36 pips. Not bad. Well, NASDAQ's on a run, and the Dow's headed up a little bit. Ooh, the DAX is on the move. Yahoo! Making money, making money. I love making money. Oh, that is just beautiful. Already up 30-something pips. Love it, love it. Sorry, I'm sorry. We haven't necessarily had the best Tuesdays lately to get too excited about, and it's just nice to see us making a good move already. So yes, and the FTSE has continued to climb higher. This is another classic example of sometimes, well, actually most of the time, the signal is right, and you're going to be wrong about your personal ideas about what the market should and shouldn't do. I have been taught this lesson so many times, and so. But again, I certainly don't regret not taking the trade. I thought the DAX setup was better. But I will be looking for a later, maybe at the end of this hour, if I can get some sort of clarity on the FTSE if the news doesn't kill the trade. So we will see. We will see. All right. Are there any questiones? Fooey to controlling our emotions. Hey, Omar. Well, like I said before, there are two sides to the emotional coin. Do you let emotions control your trading decisions? And that's a big no. That's where you shouldn't let your emotions ever play into your trading. Are they making trading decisions for you? And that should be never. But when you're in a trade, there's nothing wrong with being happy that it's winning. You know, you shouldn't beat yourself up if it's losing, because I don't think. But there's no way to avoid that kind of that twinge that you feel when you lose either, and that's just real life. I mean, it doesn't matter if you're any business that you're in. When you make an investment and it goes south, and you've done your homework and you've done your due diligence, and it doesn't work out, I'm sorry, but there's just no way for you to truly remove yourself from not feeling a little bit bad about it. Do you let it dwell? No. Do you let it affect your next decision? Absolutely not. And that's what I'm saying. You have to be able to separate your emotions from decisions. And it is human, you're absolutely right. It is human nature to enjoy your rewards. And it's also human nature to take a bit of sting from a loss. But what we have to separate is, am I going to let this affect my next trade? And the answer should be no. And do you make, you see yourself starting to lose, close the trade, close the trade. No, that shouldn't be the case either. You can't let it affect your trading decisions. So and this is one of those things, for example, and we discuss the importance of only taking trades on candle close, and that's because we have to add that structure to it because it's important. Because if you started to see this trade run and you break below 1277.65, and then you see the next candle and it starts to dip below the trend line, and you think, I'm in, oh my gosh, I'm missing the move, I better get in, and you take your sell trade, down here when it's breaking the trend line, and you take your sell trade there, and then price comes right back up into your face, and now you're underwater, and you didn't wait till the candle closed, because had you waited till the candle closed, you wouldn't have even taken the trade, and now you're mad at yourself, and now all of a sudden all these emotions are negatively affecting your trading capacity and your decision-making abilities, and now you are no longer in control, and you are no longer coming from a point of confidence and just enjoying the power you have as a trader using a good system. In fact, you're just letting the market have its way with you, and that's never a position we want to be in. Like I said, we don't want to feel bad about losing good trades, and we never want to feel good about winning bad trades. We always want to take good trades, win or lose, and feel good about them. And we always want to avoid taking bad trades, win or lose, and just don't take them. Yeah, been there, never again. Exactly. And I think that most of us that are sitting here in this webinar can at least relate 1 or 1,000 stories about where they've been there. And I have been there many, many times. And that's why I am the way I am now. And that's how we learn. You know, I don't think anybody can waltz into this business and be perfect and never make a mistake and never know what it's like to just absolutely loathe your decision. I have personally almost walked away from trading a dozen times. It's been a long time since I felt that way, you know, and I'm telling you, without my wonderful wife, I wouldn't be here sitting with you guys today saying anything about trading. I would be doing something completely different. She's the only one, because my family told me that it was a waste of my time and that it was stupid and that there's no way I could ever succeed at it. And my friends laughed at me when they were all going out and I was at home studying my charts, and they thought I was stupid for doing that. And you know, there's going to be a lot of people that are outside of that world that are going to tell you what you're doing is stupid and that you'll never make it. In fact, a lot of your own experiences are going to tell you the same thing. Yeah, thank your wife. Yeah, well, you know, I do. And you know, I try to give her the respect and the props she deserves, because she's the one who told me, get over it. You know, as Mark says, moveon.com. Get over it. You know, take a break. You'll get back. You'll be able to do it. You'll be able to do it. And so I'm very blessed to have her, and she's made me stick to it, even when everybody else in my personal life was like, "You're a fool for deciding to do this, and why would you ever risk your own money to do this?" And you know, I think had I given up any one of those dozen times and walked away forever, I would have never got to enjoy what do I enjoy now. And you know, I've recently just got to add to that by having all of you together in one place and all working together for the same goal. And I think that's, for me, that's the next step, is that we put together a proper team of traders, and instead of all having to do it, you know, unsupported and all on our own, it's better to have this group all working with the same system towards the same goal. And I just think that over time, the results are going to prove that. So that's my soapbox session for the day. But are there, yeah, let's see here. A negative dwelling can cripple you. It is best to move on as quickly as possible. I agree. I agree. There is a lot of psychology that would back that up. And if you guys have ever heard of Rich Friesen, I've got to do a couple of one-on-one sessions with that guy, and you know, he's really, really good at putting you in the right state of mind and being able to overcome most of the time. That, you know, and that's why I think I've discussed with one or two of you about the importance of taking responsibility for your own trading. It's really what stands in the way between success and failure, not just in trading but in business in general, is you. You know, you end up being your own worst enemy and your own best friend. Yeah, there's other players involved. You know, there's the approach, there's the market, there's, you know, there's cheaters, and there's bad brokers, and there's all sorts of these, but they're details, and the biggest challenge you have is yourself. And the first step, I think, to finally getting over the hump and getting really towards success is saying, what happens is I own it. And being able to overcome those kind of negative things that get in your head and make you take bad decisions in the future. So. Oh, and there's one other thing I wanted to bring up. The webinars, I haven't uploaded them lately. I've been having darndest time with this stupid video hosting thing. So I think I'm just going to move the next couple webinars to YouTube, and then I'll upload them to the website. The August 28th one was one I wanted to have on file because I thought that was a really good one. And today's, too, I think is good. And so I'm going to get both of them up. Hopefully within the next 12 to 24 hours, they'll both be on the website. Are there any other questions or items for discussion? anybody wants to get at before we call it a session? Oh, let's go ahead and take a look at volumes again. 45% above average. That's fantastic. Okay, this is just, I mean, you know, I tend to be conservative because I don't want to mislead anybody. I'm really happy to see that on September 2nd we're getting this good participation. So I think this is a good sign of things to come. But I don't want to get overly positive either, because the last couple Tuesdays I did that really came back and bit me in the butt. So there's potential opportunity out there if you know where to look. Let me just leave it at that. Let's see. Are you using the same 45 and 60 pip stop on DAX, NASDAQ, and indices? For the most part, yes. But after our first few weeks of just using those mechanical stops, I've learned that I'm using structure. I'm using structure more for stop than I am mechanical stops. So on the DAX, I put my stop down here, and I think that was around 50-something pips. But I definitely, you know, the 45 to 60 pip thing is more of a qualifier now. I try to only take trades that will give me a structural protection that is not more than 45 to 60 pips stop loss, but I'm not using it purely mechanically like I do on gold. On gold, my stop is always 45 pips with a few exceptions that it's 60 pips, and those are very mechanical in nature. What I've learned with all the other, with oil, with the indices, is that I'm using structure a lot more. And what's happening is that on the FTSE, I'm generally going with our FTSE expert's recommendations and using very small stops because his back tests show that you don't really need much more than, I think it was 10 to 15 pips. So I'm just going with that. But again, I'm still looking for structure for protection. So today, had I taken my entry here, my stop loss would have been down here. So I would have had super convergence and a midterm fib for protection. If I wanted, and that's just because basically the daily range on the FTSE is so is such that I want to still keep my reward risk ratio in line. When using structure, do you still limit how big the stop would be, or do you set your stop and then the lot size to control risk? Okay, so basically, it's one of those trade qualifier questions. So I'm always, before I set my trade, I know my stop. And then I know my stop is going to then reflect my lot size for risk percentage. So that whole rule never changes. But what I'm using is I'm going to use structure to determine my stop first, and then I'm going to say, is this structure that I'm looking for, is this creating a 45 pip stop? Is it creating a 100 pip stop? And if it's creating a 100 pip stop, I'm not taking the trade. Because although I can use a smaller lot size to give me that same risk percentage, I'm just not comfortable with that as far as what I can comfortably aim for on the reward risk side. So I know a good oil trade is going to give me between 100 and 200 pips in one day. And therefore, I want my stop size to be 50, 60 pips, you know, between 45 and 60 pips, so that I have a nice reward risk ratio, so that because we're now that we're moving outside of Forex and trading commodities and indices, we may get a little higher volatility, especially with oil and gold. And I'm speaking definitely to oil and gold here, is that we may get a lot of volatility when we trade these commodities, where we may have to eat a couple losses on the way to a big win. So even though I still think that we do very, very well as far as win percentage goes, I always want to make sure that I am only taking trades that fit within that set. I lost sound. Am I the only one? Just as you were replying to my question. I don't know. My sound meter is still going. I will definitely repeat it again, but just give me the okay that you can hear me. Okay, it sounds okay from you. I just want to make sure who asked me the question can now hear me. It's okay for you. In case he can't hear me, I'm going to go ahead and reply. The question is, can you explain how you see those pips with your mouse? Yes. So there is this tool here. It's got a little crosshair. And when I select it and move it on the chart, you can see that it's got an x-axis and a y-axis. So we're going to choose the y-axis to go, well, the y-axis doesn't matter as much. The x-axis, the side to side one, the horizontal bar, pardon me. Oh, the Brent trade's moving now. Oh, yay. Okay. Oh, look at it go. Look at it go. Anyway, what we're going to do is we're going to take the horizontal line and we're going to move it to the top of where we want the study. So if we're looking at the very tippy top of this move here on the FTSE and we want to see how many pips is between the very tippy top of this move and below, let's say, that blue super convergence zone, we're going to hold the left mouse button and we're going to drag it down, and you can see the number in the middle. The number in the middle is going to go up and down as I move up and down, and that number as I go down is going to increase, and that number in the middle is pips. It's pips if you put a decimal point after, so this right here, it says 247. That's 24.7 pips. On things like oil, let me go ahead and get oil over here as an example, which is now moving beautifully. As we look at oil, oh no, this is let's do crude. Let's do crude, because crude is direct pips to cents. So as I look at crude and I say from the super convergence zone down to the next one, you can see in the middle it says 68, 69, 70. That's direct pips. So that's 71 pips between the two super convergence zones. And then the number on the right is the price that that area is at. Does that make sense? Okay, great. All right. Okay, my friends. Are there any other... Oh, hold on. Here's another one. Is the Forex Factory liquidity percentage you mentioned for the last hour, or for the trading session so far to that point, i.e., since London session open? It's a current level, I think, based off the aggregate of the last. It's like a exponentially weighted thing. So they take the last few minutes of trading volume, and that's heavier weighted, but I think it goes back 15 minutes. It's a very current figure. In fact, you'll see right after news comes out, if you refresh, because it doesn't update live, but you can refresh it. If you refresh it constantly as news comes out, you'll see that number just jump up. So it's a very current liquidity percentage, and it changes often during active market times. So as we hit the home button to refresh it, we get liquidity is 60% above average. If we refresh again, this might be too soon, but it's a very up to the second kind of liquidity. And so as, like, if news had just come out and it's a big flow of liquidity into the market, you would see it update almost immediately. So it's a very, very well, I don't know about the accuracy, because it's, again, they're only pooling a bunch of brokers together and asking them how much trading volume they're getting. And so, but it's a really nice little barometer for how active the markets are. And on that note, guys, again, we have another webinar on Thursday. I hope to see you all there. Thank you very much. Another great session because of you, my friend. And I just appreciate everything, guys. And I'll catch you in the forum for sure. Hopefully this is just the start of a really awesome fall. And it looks like gold may take us down. We'll see. Thanks, Omar. Useful session. Thank you. I appreciate that. Thank you very much. I appreciate it. Yeah, you have a great and profitable day, too. Thank you. I appreciate that. It's very kind of you. You guys have a great day. Thank you so much. Cheers. I appreciate it.